back to the crypto investors, which is not a surprise. Okay, so someone is asking about strategies for mitigating crypto gains. Okay, so there are typically 6 strategies, right? So the 2 that most people will talk about. So I'll start with the 2 that most people will talk about, and there are 2 more that there's some people that push it, but there's so many terms and conditions around it that you may or may not find it restrictive. And then there are 2 that people talk to us the most about. So 6 things. Okay. So the first 2 will be loss harvesting and just trying to manage your portfolio to pursue long-term capital gains rather than short-term capital gains. So the latter just makes a lot more sense. When you have short-term capital gains, that's going to be taxed at ordinary tax rates, right? Which could be, 35, 37%, right? But if it is, you have longer-term capital gains, so more than a year, then you're all the way down to 20 plus the net investment tax. So let's say 22% or 22, 23%. So that's a huge tax saving on its own. Just try to manage your portfolio to have a situation where you can, if you can, you have long-term capital gains as opposed to short-term capital gains. Loss harvesting. So at this point in time, and it may change. So this is one of those strategies that may be out the door soon. Loss harvesting. So at this point in time, unlike other securities, you can't do this with like Apple or Tesla shares or whatever. This is only for crypto at this point because they're not considered securities. They're just considered property, right? From a US tax perspective. So at this point in time, you can, it's already too late. But if it is that you were involved in a strategy session with your tax professional at the end of last year, they could have recommended you, okay, if it is that you're up on certain tokens and you're down on certain tokens, you can do something called loss harvesting, which is you just, you convert to Fiat, or you can convert to a stable coin or to maybe Bitcoin. And then just wait a few days, and then you can repurchase that same token. So you can just you can maintain that position while realizing that loss, and that capital loss will be used to offset capital gains. And so that loss harvesting is what we talk about when we talk about using capital losses to offset capital gains, right? So those are the 2 that you just Google for 5 minutes and lots of people talk about that. The other 2, which are really kind of complicated, and there's a lot of discussion around it, but when I speak to clients about it, they take a deeper dive into it, and we refer them to attorneys to walk them through it. They get cold feet and they walk away, and that's the opportunity zones and the charitable remainder trusts. So essentially, both are similar in that you basically take them and you lock them up in a structure, in this case the opportunity zone, or you give it away completely with the charitable remainder trust because it's transferred into a trust. So either way, you don't necessarily have full control over it, over that portfolio anymore, in a way. And with the opportunity zone, it can reduce depending on how long you're willing to leave it in. You can reduce the ultimate tax bill, or in some conditions, it might be eliminated completely. With the charitable remainder trust, you get distributions and you'll pay tax on the distributions that come to you. But you can, as a whole, it will in theory, dramatically reduce what your tax bill would be. But it just has lots of terms and conditions, and people don't feel comfortable with it. But I'm not saying that it should. It will work for the right people. If you want, just reach out to me and I'll introduce you to some of the attorneys that we work with that can walk you through it, and you can figure out if it's the right fit for you. The last two where we have a lot of conversations with clients would be Puerto Rico and actual renunciation or expatriation. So Puerto Rico, this is kind of popular right now. Actually, I think I saw a video clip on Fox Business a few days ago. So a few days back, I remember seeing something on Fox Business about Puerto Rico. So a lot, media, but a lot of crypto investors are making their way to Puerto Rico because, as I mentioned, regardless of where you go, you will be subject to tax on your worldwide income. And, the IRS sees no difference between Detroit and Dubai. You're going to be taxed all the same. But the exception is Puerto Rico. You can enjoy a reduced tax bill if some people are able to bring it down to even zero, depending on how you structure it. So the attractiveness is there. The downside is you have to really move to Puerto Rico. You can't pretend, your center of life needs to be Puerto Rico. If that's right for you, the opportunity is there. Last but not least would be expatriation, which is where we get involved. We do probably 2 or 3 per month. These are people giving up their passport or their green cards. Yes, depending on how well their crypto portfolio may be doing, they may incur an exit tax. But if it is that you're really bullish on crypto, some people make the decision that, hey, it's better to pay an exit tax now, and at least whatever the upside is once I leave, it'll be free and clear of taxes. So it's up to you, but essentially you're looking at loss harvesting, long-term capital gains, opportunity zones, charitable, remainder trust, Puerto Rico, and expatriation. So those are your 6 options. Hope that helped.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.